Hello and welcome, I'm Suyash Maheshwari and you are watching Last Tick here on News9 where we break down the day's action on the Lal Street. And after a mid-week meltdown and the subsequent recovery that we saw on Thursday, the markets took another sharp turn closing Friday with deep cuts. And although the headliners gave away over 0.5%, today's price action in my opinion still offers some silver linings worth noting. First, Nifty, by the way, did not make a new low. It held above 21,900 odd mark in today's trade. So this is a zone where the index had taken support in the previous two sessions as well. And more importantly, Nifty also managed to close above 22,000. So as far as the sentiment goes, I think that really works out for the investors. Second, the overall breadth of the market, that has improved. Remember, the advanced decline ratio was at 1:22 on Friday, which means that one share rose for every 22 that fell. It's now at a more digestible 1:1.15. And third, the broader markets, they are not cracking, or should I rather say they are not cracking as badly as most of us were anticipating, back on Friday. Even though the mid caps, they ended lower, the small caps actually gained in today's trade. But with all that said, it was still one of the worst weeks for the Indian markets in the recent past. Nifty this week ended with a cut of over 2%. It was its worst weekly performance since October of 2023. The mid-cap index, that fell over 4.5%, and the small-cap index ended with a cut of 5.5%. This was their worst performance since December of 2022. So, worst week for the markets in nearly 50 months. Now, getting to the burning question that's on everyone's mind. Is the worst behind us, or is it merely just the calm before the storm? To answer that and more, a very special guest joins us, Andrew Holland, CEO of Avendus Capital. Thank you, Andrew. Thank you for joining us here on News. And how are you doing? I hope the stress test is not adding to your stress, sir.
Not really. I'm still kind of working out the reasoning behind the stress test. But let's see what the results come out. Because stress testing a number of days, if markets fall, it's then the liquidity, right? And I'm not sure how it all pans out. This is what I would say. I think on the way up, we tarred everything with the same brush. So everything rose, and we're doing the same on the way down. So those good companies, in good sectors with strong fundamentals, nothing's really changed. But, as markets have gone up, we've talked about this before. You've asked me about PSUs. And I said, I wasn't convinced on the narrative that, everything's changed so well that I need to be there. So, when you talk about the falls for this week, you've got to remember that most of the indexes are up, 40, 50, if not more percentage over the past year. So no bad thing taking a little bit of froth away from some of those companies that possibly shouldn't have gone up in the first place.
And do you reckon that all this fuss over the mutual fund stress test is getting a little bit out of hand? I was reading this interview from one of the top voices in this space. They were clearly of the opinion that the market is obsessing over these results, but the regulator, is just asking for basic information. According to this person, the stress test fund, the stress test that fund houses do are actually, way more tougher than what the SEBI is actually asking for. So, sure, putting this stress test out in public, in the public forum is good as far as transparency goes. But do you think, it's making everyone overly cautious?
Yeah, I'm not sure how to. Until we see the results, it's difficult to kind of comment on this. But if I'm investing in a small cap fund or a mid cap fund, I'm taking a 3 to 5 year view. On these companies, because the small or mid-cap companies now, and you're hoping that over time the fund manager would pick out the right ones which will become larger caps over that period, and therefore you make money within the fund. So I think if you take that view then and work on the basis that the companies which are chosen are fundamentally sound in great sectors, I don't think there's anything to worry about, and liquidity is always going to be difficult when markets are falling. If there's anything, we saw it in COVID, it's difficult. But after a few days, things settle down. The margin calls, which I'm sure were made a few days back, have been done. and any selling which of some of these stocks has also been has been completed, and therefore you see a little bit more stability, which is what we've been seeing in the last 2 days, to be fair.
All right, of course, a lot has been made about the froth in the broader markets. Everyone is talking about it, including the regulator. But I mean, after this sharp correction, where the headliners, they have fallen by about 10-15%. I'm talking about the Nifty mid cap index and the Nifty small cap index. But the constituent stocks, they are down somewhere close to 20-30% in just a matter of weeks. I mean, are the prices the stock prices, are they looking attractive, or would you want to wait and see them easing slightly further before initiating fresh positions?
Yeah, it's again, it goes back to each individual company and the share price fall. But what I would say is that if you're in a sector which you believe in over the longer term, then these are the opportunities you want to grab. In being able to kind of add to your holdings in those companies. So I think that's what will happen, is that it will. Those stocks which are anyway had weak fundamentals will continue to have weak fundamentals, but nothing's changed. It's not as though the economy's changed. It's not as though earnings growth has changed. And if you look around the world, you'll see many different stories about possible bubbles, whether it's from Bitcoin to the Magnificent Seven, and you're bound to have corrections. You can't go in a straight line all the time. So, use these opportunities, unless you're seeing something different than I am in terms of the economy, but nothing has changed.
All right, nothing has changed. But, sir, the fear is real. I mean, I was reading another report which said that this correction could perhaps turn into this 2018 sort of a meltdown. Back then, small caps gave away 45% from the peak. And, I mean, if you are to draw parallels, there are some between then and now. What's your sense here?
No, I could draw that. You see, there's parallels. I can give you parallels about the overall markets, globally to the late or early 90s in terms of the tech bubble. But it's got to happen first, right? So what we have is momentum, and that's really what's been pushing share prices higher. And sometimes you can't fight that momentum until it stops. But what I would say about the small caps is what I've read as well is that. A large proportion, 60 to 70% of the money going into small and mid caps has been through SIPs. Now that's not stopping, to my mind. So, I don't think it's chasing all these stocks. Might be individually some of them, but for the funds themselves, they've been getting steady flows. Now, if you take from 2018, I'm sure those flows would be a lot larger now into small and mid caps than they were back then.
All right, and what do you, do you like what the regulator is doing here, ringing alarm bells about the excess now, so perhaps there isn't a collapse later on?
See, I think again it goes back to your investor and their kind of time horizon. If you've got a longer term time horizon, and you're looking at the economy over the next 3 to 4 years. I mean, I was very fortunate to be at your conference 2 or 3 weeks ago, where everyone was talking about the economy being at least 10 trillion by the end of this decade. Now, has that changed? I don't think so. So if you've got that combination of strong economic growth, interest rates will fall. This is usually good for domestic small and mid cap companies in that environment. So again, if you pick the right sectors, I think you'll be fine.
All right, but what I really meant to ask was, the regulators are stepping up and saying there is froth in the system, because that is unprecedented. We do not hear from the regulator talking about the market movements on a day-to-day basis.
Yeah, I mean, obviously they had some feeling of uneasiness, and that's what they obviously articulated to the market. So let's see the stress test. Let's see how it comes out. But fortunately, the last 2 days have seen a little bit more I would say more settled kind of trades and getting back to normal.
Fair enough. And what's your view on PSUs now? I mean, is the glorious run over, or is there still money to be made here?
No, of course there's money to be made over the longer term, but I think what happens is that you get kind of themes that play out very strongly. in certain sectors, or the PSU theme played out wonderfully well, and people have made a lot of money. So taking some of that off the table is not a bad thing. But again, nothing's changed for those companies within the sectors, apart from maybe some of the valuations have run ahead of themselves, and that's all it is. They've run ahead of themselves, and therefore you get a correction like this, and it's a good opportunity to look again. I haven't kind of switched yet from. Let's just take the PSU banks. We talked about those many times. I wasn't convinced. It's been a great rally. I'd rather be in the private banks. They've been beaten down, and probably they would be the first ones to rally in the financials than PSU banks at the beginning.
All right, and moving on to the global markets, the three horsemen, the 10-year bond yields in the US, the dollar index, crude, all are riding against us lately. I mean, crude prices especially, week on week, Brent crude is up over 4%. It's back above $85 a barrel. Do you reckon that's going to spell trouble for us in the upcoming months?
No, not really. I think, obviously, if I take the view that China is still not picking up, then oil prices will probably, stabilize, if not fall from here a little bit. In terms of bond yields in the US, I mean, some of the data has been a little bit more, hotter than the market would like. But the market's still saying the interest rates are coming down. So we'll see what the Fed has to say on the 19th, 20th of March and see if that dovish stance is changing a bit. But I doubt it. The data is not so hot that, I think he would have Chairman Powell pivoting again. So, retail sales in the US were down. So all of these things are starting to kind of move in the right direction, probably not as quick as the market would like. So I'm not so worried. I mean, the only thing that worries me, if you want to know what worries me the most, is that, when these figures come better or hotter than the market expects, the kind of narrative is, well, it could have been worse, so the market goes up, and that doesn't have any fundamental ring to it, to my mind. So again, the momentum's there in global markets as well as our own market up until recently.
Right, and sir, a month ago when we met at the News9 summit, you said that you were expecting a pre-election rally. Is that still on the cards? I mean, we are just a month or two away.
Yeah, I mean, we could have still a move ahead. Towards the back end of this month. It's the quarter or year ending for everyone. So maybe we'll see a small rally in the markets ahead of that. And obviously optimism of the outcome for the elections as well. I think will probably push markets higher in the very short term, unless there's something globally happens, which I'm not seeing on the horizon at the moment.
All right, pre-election rally could still be on the cards unless there are some troubles brewing in the global markets. That's a word coming in from Andrew Holland. Sir, appreciate your time, appreciate your thoughts. Thank you for joining us here on News9.
Pleasure. Thank you for the opportunity.
But before we wrap things up, let's look at the top headline. I mean, government has approved a new EV policy to promote India as a manufacturing destination. As per the policy, companies need to invest a minimum of 4,150 crore rupees in the country. The policy also mandates that these companies should establish local manufacturing facilities within 3 years. Not just this, the automobile companies should achieve a localization level of 50% within 5 years, and 25% of the components should be locally sourced. Now, companies that are able to meet these requirements will be able to import 8,000 EVs per year, and an import duty of only 15% will be applicable on EVs priced $35,000 and above. Currently, India levies a tax of 70% or 100% on imported cars. With that, it's a wrap on this edition of Classic. Thank you for watching.
Start with the end in mind. You need to know where you want to reach. Every morning that we wake up, we are exercising our choice. The destiny is decided. The results are known that I'm going to win. life of a goalkeeper is something which has always intrigued me.
When you come into a stadium, this is the highest level of pressure.
When I set out to do something, I decide in my mind that failure is not an option.
What you feel very strongly about, those are the stories to tell.
I have a mind which is absolutely restless.
Mind and body are entangled sensations.
That brings me back to golf. It's an amazing game.
This is not a perfect game. You only learn from them.
If you have a formula to a success, then you can replicate it.
I feel this is my first step. I'm starting now.
Winner is first born in the mind. I think, therefore I am. We are all about our mind.
This and more. Streaming on News9, plus subscribe and get free vouchers.
Hello and welcome. You're watching Business Plus. We are giving you stories of business policy and economy. I'm Shweta Kothari. Here are the top headlines we're tracking at this hour. Petrol diesel gets cheaper. Oil marketing companies slash prices of petrol and diesel by 2 rupees each. Paytm UPI to continue after March 15th. Paytm gets NPCI note to become a third-party UPI app. And gross negligence by Baiju's auditor, chartered accountant Apex body recommends punitive actions. Startups can add $1 trillion to the Indian economy by 2030. CII report says 50 million new jobs will also be added. And we're tracking, of course, all those stories here on News9. The top story we are discussing is by the way of petrol diesel prices, which was slashed as of last evening by 2 rupees each. Karthik Malhotra joining me here. Karthik, oil marketing companies have finally slashed down that costly prices of petrol and diesel by 2 rupees. This is the first time in 2 years we're looking at a revision of prices.
You're right, Shweta. I think the last time we saw, in fact, a revision of prices and a price, being stabilized then for a fairly longish period was in May 2022. So a little